Listen to me very carefully, because what I am about to say might save your financial future. The old rules of money are dead. If you are still holding on to the traditional 60-40 portfolio split in 2026, you are not just standing still, you are actively losing wealth. We are living through one of the most confusing economic shifts in history. Interest rates are volatile. Artificial intelligence is rewriting entire industries overnight, and the cost of living feels like it is on a runaway train. But here's the good news. Chaos creates opportunity. While the masses are panicking or putting their cash under a mattress, the smart money is moving into specific, high-growth and inflation-resistant assets. Today, I am going to show you exactly how to build the perfect portfolio for this year. No fluff, no guessing, just a blueprint for building serious wealth. Hi everyone, I'm Tim. I'm a finance expert and I spend my days analyzing market data so you don't have to. My goal is simple, to help you navigate this financial maze and come out richer on the other side. If you are tired of generic advice that doesn't work anymore, you're in the right place. Today, we are tearing down the old portfolio models and rebuilding something stronger, something bulletproof. We are going to look at exactly where to put your money right now to maximize upside while protecting your downside. Let's start by addressing the elephant in the room. Why is the old advice failing us? For decades, financial advisors told us to put 60% of our money in stocks and 40% in bonds. It was the golden rule. But in the current economic climate, bonds aren't the safety net they used to be, and the stock market is becoming increasingly concentrated in just a few massive tech giants. If one of those giants stumbles, your entire retirement fund takes a hit. We need a new strategy. We need what I call the asymmetric upside portfolio. This means we are looking for investments where the potential for gain vastly outweighs the risk of loss. The first pillar of our 2026 perfect portfolio is what I call the innovation core. This is not just buying the S&P 500 and hoping for the best. We need to be surgical. We are allocating about 35% of our portfolio here. This year, the biggest driver of wealth isn't just tech, it's specifically the infrastructure of the future. I am talking about companies that are building the hardware for AI, the next generation of cybersecurity, and clean energy storage. These are not speculative plays anymore. These are the new utilities. Think about it. AI isn't a fad. It is the new electricity. Companies that manufacture the chips, the data centers, and the cooling systems for these technologies are seeing revenue growth that traditional consumer goods companies can only dream of. However, a word of caution, do not just buy the hype. You want companies with strong cash flows and wide moats. When you're picking individual stocks or ETFs for this innovation core, look for the pick and shovel plays. In the gold rush, the people who got richest weren't the ones digging for gold, it was the ones selling the shovels. In 2026, the shovels are semiconductors and cloud infrastructure. If you position 35% of your capital here, you are capturing the growth of the decade. Now, before we move to the defensive side of things, I want to quickly remind you to please subscribe to the channel and hit that like button if you are finding value in this breakdown. It really helps me get this information to more people who need to take control of their finances. Just a quick tap and you help us grow the community. Thank you. All right, let's pivot to the second pillar, real assets. In an environment where currency debasement is a real fear for many, paper assets can feel risky. That's why for 2026, we are allocating 25% of the portfolio to tangible, real assets. But I am not necessarily talking about buying a rental property and dealing with fixing toilets at midnight. I am talking about modern access to real estate and commodities. Real estate investment trusts, or REIT, are looking particularly attractive right now, specifically in sectors like industrial warehousing and healthcare facilities. Think about the aging population. Healthcare facilities are in higher demand than ever. Think about e-commerce. Every package you order needs to be stored in a warehouse before it gets to your door. These are recession-resistant trends.
By investing in REITs that specialize in these areas, you get the appreciation of real estate and the cash flow of dividends without the headache of being a landlord. Furthermore, under the umbrella of real assets, we cannot ignore commodities. Gold and silver have historically been the ultimate hedge against uncertainty. In 2026, having a small, roughly 5 to 10% slice of your portfolio in precious metals acts as insurance. It stabilizes your portfolio when the stock market gets choppy. It's not about getting rich quick with gold. It's about staying rich when everything else is falling apart.
Now, let's talk about the engine that keeps the car running, regardless of the weather. The third pillar of our portfolio is the income engine. We're allocating 20% of our funds here. In the old days, bonds were the boring part of the portfolio that barely kept up with inflation. Today, the landscape has shifted. We're looking for high-quality, dividend-paying stocks and short-term government bonds. Why? Because cash flow is king. When the market trades sideways, which it often does, you want investments that pay you just for owning them. Focus on companies with a history of raising their dividends for 25 years or more. These are often called dividend aristocrats. They're usually boring businesses. They sell toothpaste, insurance, or food. But boring is beautiful when it compounds at 8 or 9% a year. Coupled with short-term treasuries that are offering solid yields with virtually zero risk, this section of your portfolio acts as your paycheck. It provides the liquidity you need to buy more aggressive assets when they go on sale during a market correction. It's the defensive line that protects your wealth from eroding. This brings us to the most exciting yet dangerous part of the 2026 portfolio. The fourth pillar is the asymmetric bet. We're putting roughly 10 to 15% here. This is the money you can afford to lose, but if it wins big. In 2026, we cannot ignore the digital asset revolution. I'm talking primarily about Bitcoin and potentially high-conviction innovative startups. Institutional adoption of cryptocurrency has moved past the "is it real" phase to the "how much should we hold" phase. Major asset managers are now integrating digital assets into their funds. However, you must be disciplined. This is not gambling. This is calculated risk. The goal with this 10% is to capture exponential growth that stocks or real estate simply cannot offer. If this portion of your portfolio doubles or triples, you skim off the profits and move them back into your boring income engine. That's the secret. You use the high-risk plays to feed the safe plays. Most people get this wrong. They double down when they're winning and lose it all when the cycle turns. We're going to be smarter than that. We take profits on the way up. Finally, the remaining 5 to 10% is dry powder. This is cash or cash equivalents sitting on the sidelines. This is your opportunity fund. The biggest mistake investors make is being 100% invested at all times. When a black swan event happens, and it will, you want to be the person with cash ready to buy high-quality assets at a discount. Having this liquidity gives you a psychological edge. When everyone else is selling in panic, you're calm because you've been waiting for this moment to deploy your dry powder. So, let's recap the perfect portfolio for 2026. You have 35% in the innovation core for growth, 25% in real assets for protection, 20% in the income engine for cash flow, 10 to 15% in asymmetric bets for exponential upside, and the remainder in cash for opportunities. This balance is designed to weather inflation, capture technological growth, and provide you with peace of mind. It's not about timing the market perfectly. It's about time in the market with the right asset allocation. Building wealth is a marathon, not a sprint. But with this setup, you're running with the wind at your back. Remember, nobody cares about your money more than you do. Take this blueprint, adapt it to your personal risk tolerance, and start taking action today. Don't let another year pass by just watching from the sidelines. If you found value in this video and want to join a community of serious investors, please make sure to subscribe to the channel and smash that like button. It really supports the channel and helps me bring you more deep dives like this one. Thank you for watching, and I will see you in the next video.